Could crypto trigger the next financial crisis? This isn't just some late-night speculation anymore. We're talking about a potential multi-trillion-dollar problem that has governments, banks, and regulators on high alert. You've probably heard of Bitcoin and Ethereum, with their wild price swings. But there's another class of crypto that was supposed to be the safe, boring cousin: stablecoins. These are digital currencies designed to hold a steady value, usually pegged one-to-one with a real-world currency like the US dollar. Sounds simple, right? For every digital dollar issued, there should be a real dollar sitting in a bank account somewhere. That's the promise. But what if that promise is built on shaky ground? Let's break it down. The top stablecoins, like Tether and USDC, have market caps in the tens of billions of dollars. They are the backbone of the entire crypto ecosystem. Think of them as the poker chips in the crypto casino. Traders use them to move in and out of more volatile assets like Bitcoin without having to cash out into traditional money every time. They provide liquidity, they facilitate transactions, and they've become an indispensable part of this new financial world. The problem is, what actually backs these stablecoins? For a long time, the answer was shrouded in mystery. Companies claimed full cash reserves, but when regulators started digging, the picture got a lot murkier. It turns out that a significant portion of these reserves isn't just cash. It's a mix of assets, including commercial paper. Now, what's commercial paper? It's basically a short-term, unsecured debt note issued by corporations. So, instead of holding your dollar in a super safe bank account, the stablecoin issuer is lending it to other companies. This introduces a whole new level of risk. What happens if those companies can't pay back their debt? This isn't a hypothetical. We saw exactly this kind of risk blow up during the 2008 financial crisis with money market funds. They held similar assets, and when one major firm, Lehman Brothers, collapsed, it caused a panic. People rushed to pull their money out. The funds couldn't sell their assets fast enough, and the entire system froze. The U.S. government had to step in and guarantee those funds to prevent a complete meltdown of the financial system. Now, imagine a similar scenario, but with stablecoins. The crypto market is famously volatile and sentiment-driven. All it would take is one major rumor or a legitimate default in the commercial paper holdings of a large stablecoin issuer to spark a bank run. Millions of users would rush to redeem their digital dollars for real dollars all at once. If the issuer can't meet those redemptions because their assets are tied up or have lost value, the stablecoin could break the buck, meaning its value would fall below $1. The consequences would be catastrophic, not just for crypto, but potentially for the wider economy. Think about it. A collapse in the biggest stablecoins would send shockwaves through the entire crypto market. Bitcoin, Ethereum, and thousands of other coins would likely crash as the primary source of liquidity vanishes. Billions, if not trillions, of dollars in perceived wealth could be wiped out in an instant, but the contagion wouldn't stop there. Remember that commercial paper? The stablecoin issuers are major players in that market. A sudden, forced sale of their holdings to meet redemptions would flood the market, causing a credit crunch for the real-world corporations that rely on this funding. This is the spillover effect that has regulators so worried. A crisis that starts in the largely unregulated world of crypto could very quickly infect the traditional financial system. It's the same kind of systemic risk we saw in 2008, just with a new digital wrapper. And this isn't just theory. We've already had a dress rehearsal. Remember the collapse of Terra Luna? Its algorithmic stablecoin, UST, wasn't backed by real-world assets, but by a complex code-based relationship with another token, Luna. When confidence in the system faltered, it entered a death spiral. $40 billion of value evaporated in a matter of days. While UST wasn't as systemically important as Tether or USDC, its collapse caused massive pain and highlighted the inherent fragility of these systems. It was a wake-up call for regulators around the world. So what are they doing about it? Governments are scrambling to get a handle on the situation. In the US, there's a major push for new legislation. One of the proposals being discussed is something called the Genius Act. It's designed to bring stablecoins under the same kind of regulatory umbrella as traditional banks. This could mean strict requirements on what kind of reserves they can hold. Think cash and short-term government bonds, not risky commercial paper. It would also likely involve regular audits, transparency reports, and capital requirements to ensure they can withstand a market shock. The goal is to make stablecoins genuinely stable and prevent a run from ever happening. The chair of the U.S. Securities and Exchange Commission, Gary Gensler, has been very vocal, comparing stablecoins to the wildcat banking era of the 19th century, a chaotic period of frequent bank failures before federal regulation was established. He and others, like Treasury Secretary Janet Yellen, have pointed out the urgent need for a regulatory framework to mitigate these growing risks. But here's the billion-dollar question. What if a major stablecoin fails before these regulations are in place? Who foots the bill? This is where things get really controversial. Experts, including Hillary Allen, a law professor specializing in financial stability, have warned that a large-scale stablecoin collapse could become so disruptive that the government might be forced to step in with a bailout. Think about that for a moment. A bailout for a private, often opaque, crypto company using taxpayer money. It's a politically explosive idea. The argument is that if the contagion threatens to take down the broader credit markets and harm regular businesses and savers, the government would have little choice but to act, just as it did in 2008. The very industry that was born out of a distrust of big banks and government intervention might end up needing them for a rescue. The irony is staggering. This creates a moral hazard. If stablecoin issuers believe they are too big to fail and will be bailed out, what incentive do they have to be prudent and manage their risks carefully? They might be encouraged to take on even more risk in pursuit of higher profits, knowing that taxpayers will ultimately bear the cost of any failure. This is the exact dilemma regulators faced with the big banks. It seems history might not just be rhyming, it could be repeating itself with a digital twist. The future of stablecoins, and by extension, crypto, is at a crossroads. On one hand, they offer the potential for faster, cheaper, and more efficient payments and financial services. On the other, they present a clear and present danger to financial stability if left unchecked. The debate is no longer about whether to regulate, but how and how quickly. The industry is pushing back, arguing that heavy-handed regulation could stifle innovation. They advocate for a more tailored approach that recognizes the unique nature of digital assets. However, regulators are haunted by the ghosts of financial crises past and are determined not to be caught flat-footed again. So, could crypto trigger the next financial crisis? The potential is absolutely there. The mechanism is eerily similar to what we've seen before: a supposedly safe asset, opaque holdings, a risk of a sudden loss of confidence, and the potential for contagion into the traditional financial system. The scale of the stablecoin market is now so large that we can't just dismiss it as a niche problem anymore. It's a systemic issue. Whether we can defuse this ticking time bomb through smart, effective regulation before it's too late remains to be seen. The next 12 to 24 months will be crucial. The decisions made in Washington, Brussels, and other global capitals will determine whether stablecoins become a stable foundation for the future of finance or the trigger for its next major crisis. What do you think? Are regulators overreacting, or are we sleeping on the verge of a crypto-induced financial meltdown? Let me know your thoughts down in the comments. This is a conversation we all need to be having. Thanks for watching, and if you found this breakdown valuable, make sure to like this video and subscribe for more deep dives into the forces shaping our world. See you in the next one.